Hi everyone, my name is Peter Pikalski. Today we have a final overview of financial model of an apartment complex. Um, I'll be showing you what parameters affect this business model. I'll be showing you how people usually want to play with scenario analysis inside apartment complex financial model. So if you find this video valuable, you may give us a like, subscribe, share this video with your friends. Also, you can order financial model from scratch for your unique business idea. And let's start. First of all, I would like to say that all imports in our financial model is marked with this blue color, like this, like this, like this. All other cells are automatic. We don't put any date there. So first of all, we set up the year when we start investment stage. So this is the first year when we start spending money on our business idea. Then we have, by the way, this is also new. Then we have different types of apartments. We have studios, 1 bedroom, 2 bedroom, 3 bedroom apartments. And we can switch them on and off from calculations inside our financial model. So basically, how our financial model is organized. So the first spreadsheet is the model itself. Then the next spreadsheet is a simple table where we have total revenues, total expenses, profit, profitability, calculation of simple and discounted payback period moments. Then we have a simple and discounted payback period diagram to make us able to see when we have the moment of payback, simple and discounted payback period. Then we have internal rate of return spreadsheet where we specify the discount rate and step of calculation, the discount rate. Then we have a sensitivity analysis tab where we specify the pace of changing the parameter. Here we can see the basic financials that we have, and here we will be able to see the performance of the business idea if we increase or decrease the value of parameter that we would like to dive into. So first of all, let's start with the model itself. First of all, we name the type that we have. For example, we have 4 types of apartments. We can, for example, switch off all studios from the calculation. So we just put here off. Then we go to simple and discounted payback period diagram. Just wait a little bit for Microsoft Excel to calculate the date. See how that diagram changes. Then we can specify footage of
Each type of apartment. For studios will be 60 square feet, 90, 120, 150.
So we can assign the square footage of different types of apartments. Then we specify the rent for each type of apartments. Then we can add the coefficient for rent for different types of apartments to make us easily play with scenarios. For example, if we want to change this value, we just can assume
Quickly create the scenario what will happen. We will, for example, the rent price will be 90% of what we have today. For example, we can create the coefficient, specify the value of coefficient. Go back to the simple and discounted payback
here. Just wait a little bit till Microsoft Excel calculate the data. See the parameters, and we
coefficients for different types of apartments, or we can play coefficient with coefficients for all types of apartments at the same time. So this is very interesting to see what will be the performance. Then we can add coefficients for square footage of our different types of apartments. For example, we want to see what will be the financial efficiency if we build studios, for example, 30% higher in square footage than in our basic scenario. So there will be 78 square feet. So this means that the investment plan will be bigger, the rent will be bigger. So what will be so the rent will stay the same, by the way, but the square footage will be bigger. So what will be the payback period? So we can look simple and discounted payback period and see what will happen. So now we're moving to so we talked about the square footage of different types of apartments. We talked about the rent. We have the coefficient to the rent. We have the coefficient to square footage. Then we specify the construction cost per square feet, and also have a coefficient for all construction costs. For example, the basic value is 100. But for example, we can quickly create the scenario of what will happen if, for example, the investment, the construction cost will be, for example, 50% higher than in our basic scenario. So we just specify here 150. Then we go back to the simple and period and see what will be the diagrams for counted payback period. So now we go back to specify our basic values. Then we specify when we start the operating activity, when the first operating expenses occur. So this is the moment when we end up with investment stage and move to operating stage. So this is the moment when we start operating activity. Then we have the core of our financial model. Here in the core we specify we have 300 apartments that we have in our on the right we specify what type of apartment it is. So it can be a studio, 1 bedroom, 2 bedroom, 3 bedrooms. So we specify here what it is. Then we can, for example, switch on and off this specific apartment from calculations. So for example, we can switch off all studios. So we have no studios here. But for example, we want to leave all studios here, but we don't want to have all of them. We can just take, for example, some of them we can switch off. And we can do like this. We can see zeros here, and this will affect all our financial efficiency numbers, simple and discounted payback period diagrams, and so on. What we have next? Next, we specify when we start operating activity, we specify how fast we find the first tenant, because during this period we may have some operating losses. And we can specify for different types of apartments. We can specify how long does it take us to find the first tenant in months. So if we put here 0, it means that we find the tenant right from the first month of operating activity. If we have a 1 here, it means that it takes us 1 month to find a tenant from the moment when we start operating activity.
And here we can specify how fast we find the first tenant from the moment when we start operating activity. And then we specify the average term of contract with the tenant. For example, it takes us 4 months to get the first tenant, and we sign a contract with him on 18 months, or we may specify for 2 years, for 24 months, or 36 months, or 5 years. Here will be 60 months. And then we specify when this contract will be over, how much time it will take us to find a new tenant, to make us calculate the operating losses while the apartment will be empty and it won't generate the revenues. So this is the contract, then pause, then new contract, then pause, then contract, then pause. So this is the first, the timing for searching the first tenant, then the contract, then pause, contract, then pause. So this is the cycle. So here we have the core where we specify all these parameters.
Then we are moving to the next block of inputs. Here we have the investment plan articles. So at the end of the core, we have the total investment needed to build all these apartments. And then we allocate this number among the investment articles in percentage. We also have some coefficients to increase or decrease expenses for this or that investment article. So this is a specific coefficient for this or that investment article. So this is very convenient story when you have to, for example, to create the scenario if the investment articles the expenses for this or that article will rapidly grow. So for example, this article will stay the same, but the investment for this article, for example, will grow 3 times. For example, what will happen with financial efficiency, for example. So this is very important when you create numerous amount of scenarios. So playing with this number is very important. So we allocated this investment plan among the articles. Then we allocate this amount of investment inside the timeline in percentage. Here it is. So this is the moment when we start operating activity, and here we allocate in percentages to make the final 100% for each investment article. So for example, if we have 49%, we didn't get we didn't have 100% here, so it is a mistake. We have to add 1%. So if we go higher or lower, we'll get a mistake. So this is the investment stage. Then we were moving to the operating expenses stage. So we have direct costs. Here we have the total square footage of an apartment complex. Here we have the coefficients to the total direct costs. For example, if we just want to increase the total amount of direct costs on 20%, let's say. So this is the first story, for example, and we're looking at the simple and discounted payback period and see what will be the simple and discounted payback period if we increase the direct cost on 20%. And for example, we just want to see what will happen if specific direct costs expense, for example, like this, will additionally rise on 30%, for example. And we can go to the diagram and see what will be the performance of the business. So usually the business owners want to look at this or that scenario very quickly without adjusting of manual adjustment of the inputs. So playing with coefficients is very convenient.
Then we have the block for fixed costs. So here we have the typical year for fixed costs. Here we have here on the left we have the fixed cost items, different expenses, and here inside the typical year with penalty of expenses for each type of expense. And also we have a coefficient to play to if we want completely increase or decrease on some percentage the value of these expenses. So some expenses will occur in winter, some of them will occur in spring, some of them will occur in, for example, summer, some of them will occur once in 3 months, or specific algorithms, so we can play with this algorithm inside. So these are the fixed costs. Here we have also the coefficient for all fixed costs to increase them or decrease. Then we have the block for payroll. Then we specify how many people we have on each position. Then we have coefficients for salaries for each position. We can also play with all salaries expenses, just using only this coefficient, not only these. So these are coefficients specifically for this position, but also we can add coefficient for all payroll expenses. Then we can add a loan to our project. We can specify the year when we take it, month when we take it, amount of the loan, interest rate, term of the loan, grace period for principal payments, for interest payments. Then we specify the rates of taxes, and then we have finally we have the cash flow statement, where we gather all the revenues, direct costs, fixed costs, payroll. We can press plus and see the detailed expenses. Here we can see the result from operating activity when we start the business. So when we start operating activity, we can see the net profit. We can see in investment stage, during the investment stage, we can see how much financing and when we need on the investment stage when we are building our apartment complex. Then here we can see the amount of equity that we need. We can see also here where we get the loan, the payments for the loan, and also here we can see the total amount of financing that we need to start this project. As I already told you, we have a specific table where we have the total revenues, total expenses, profitability, simple and discounted payback period. Then we have, as you know, simple and discounted payback period diagrams for the project to make us just see the clear picture of it. Then we can specify the discount rate, the pace of changing the discount rate, and then we have a very interesting tab which is called sensitivity analysis. So we can in this tab we can add a parameter to any input and play with it. For example, we can add a parameter to for example, construction costs. For example, we just can do like this. We can take equals, multiply, then we take this coefficient, add it, so now we've added a coefficient to all construction costs, and now we go back. We just want the step of changing the parameter will be 20%. If we have it, we would like to adjust it to 10, so this will be 10% step. So for example, we just take 20% step, So, and then we just press the sense button and see what will happen. So here we can see that if the cost of construction increases on 40%, we will have negative net present value and our business ID will go negative. So we can, for example, we just delete these values, then we go back, delete this story from construction costs. And for example, we would like to see the performance of our business ID if we add these coefficients, for example, only to 3-bedroom apartments rent. So we just take only this value. Then we will add the coefficient. So here we have our coefficient added. Then we go back to sensitivity analysis tab. Then we just push this sense button and see how increase or decrease of rent prices for a 3-bedroom apartment will affect the financial efficiency tab. Let's do it. So we can see that if we have a decrease in 20% in rent price, that then we will go negative. For example, we can just change the step of calculation by 5% and make a more detailed sensitivity analysis. We can even don't delete this. The macro will do it. It's worked automatically. So here we can see that 15% is okay, but 20% we're going to negative. So, and we can test absolutely any parameter and see what will be, how it affects the financial efficiency. So this is very valuable thing during scenario analysis. This can show you the business owner, the strengths, then the weaknesses of his business idea. He can add this parameter to any inputs, see how it affects the simple discounted payback period, internal rate of return, how it affects the amount of financing that he needs. So I think you enjoyed this video. If you found something interesting, valuable, you may give us a like, subscribe, share this video with your friends, write a comment. Also, you can order financial model from scratch for your unique business idea. We can help you with that. So see you guys in next videos. Thank you and bye.